Ladies and gentlemen, colleagues, good morning to all of you and welcome at the Austrian National Bank for this conference together with the Environment Agency, but also with the ministry. We are the hosts of this event, and for us it is very important to say that this cooperation has been going on for quite a while. And the Austrian National Bank has been a member of the network for green finance for a long time. And we have learned a lot from the expertise and the knowledge of this platform. And this is why we loved the opportunity to host this conference. And at the same time, it was important for me to say that we need a balanced discussion, because I think that's the best way to discuss. This conference is taking place in difficult times. Climate change is not the most important topic of the political agenda anymore, at least of many countries. And that is partly understandable, as geopolitical developments and trade conflicts are enormous risks and have to be addressed. But nevertheless, it is very short-sighted to set completely new priorities, because climate issues cannot be pushed aside. Most people know this, and you see that in the service as well, because climate and environment are just after security, migration, and economy very important areas of actions for EU citizens. So it's not a question of tackling one or the other, but tackling them all together. I would like to introduce 6 points and then finalize with the conclusion. The first one would be the economics of climate change. And I would like to introduce the subject in a fundamental way as an economist and central banker. And I will be taking the findings of climate science as a given. The former chief economist of the World Bank, Lord Nicholas Stern, is a former colleague and old friend as well, has described climate change as the greatest market failure. In fact, but there is no market, because greenhouse gas emissions have no market price, so polluters can pass on the costs of their climate damaging actions to society and future generations. And in theory, at least, the problem can be solved by introducing a tax named after the British economist Arthur Pigou. And this would make the economy climate friendly in an efficient, market-based, transparent, and technology neutral way. Friedrich Hayek described market prices as a machinery for registering change. And indeed, price signals, market prices, are essential for subsidies and for a successful climate transition. And discussions have shown that these topics are important. Unfortunately, market prices are facing political resistance, and the potential losers are screaming a lot louder than the numerous winners. On the other hand, there are also regulatory climate protection measures. And these direct interventions in economic activities are not very popular because they distort the market mechanisms. As we have seen with the CFC's ban, it does help. In general, however, I think this type of picking the winner, as it is done by politicians, is problematic. I'll come to the second part now, the role of green finance. Next to the regulatory measures, intervention in the financial system is an option, and this is our conference topic. At the first glance, that seems logical, because hardly any investment decision can avoid the financial markets. But for the transition to a low carbon economy, you need capital. I look at green finance from a perspective of a regulator, because I don't believe that altruistic commitment can do much to address market failures. And it won't do so in the future. Rather, we need private financial market rules and incentives to channel resources into environmentally friendly activities. A risk-based approach would also be an option. Financial risks that are not fully priced in are climate risks. The Princeton economist Markus Brunnermeier describes this as an attempt to create a risk premium tax through uncertainty about future regulatory measures, such as a carbon tax. Unlike a tax on emissions, however, the revenue would not go to the budget, but to private insurers of these transition risks. The other option of the green finance regulatory approach is to use disclosure requirements and incentives to motivate financial market players to act proactively. Here the focus is not on the risks, but on the opportunities. The EU combines both approaches in the sense of double materiality. So it is both about the impact of business on the environment and vice versa. One aspect of this is the fight against greenwashing to avoid misleading consumers and investors. To avoid investors being pulled in the wrong direction. Now I would like to continue with point 3, the ESG ups and downs. In the Anglo-Saxon world, the focus is on risk approach under the acronym ESG, environment, social, and governance. Now, however, even the voluntary commitment of companies is coming under political fire in the US. Voluntary networks of financial market players are said to be a threat to investor freedom. ESG is called woke. Shareholder activism is seen as an anti-competitive collusion that violates antitrust laws. Last year alone, 10 Republican-led states passed anti-ESG laws. But doesn't that limit entrepreneurial freedom, this type of ban? Market-based ESG initiatives address a need for transparency. Institutional investors have a fiduciary duty to their clients. They need to understand how the companies they invest in are prepared for long-term challenges. So it would be absurd if asset managers were not allowed to consider climate-related risks. The new US administration is weakening existing regulations. Government agencies are becoming understaffed and less able to provide oversight. Unfortunately, the Securities and Exchange Commission and the Federal Reserve are also retreating from regulating sustainability risks. In some states, ESG risks remain important, but the damage is done. Banks are afraid of politics and lawsuits and are leaving the Net Zero Alliance, and companies are afraid to commit to sustainability. Green bashing is followed by green hushing. The economist Robert Ingle says the market will continue to price climate risks even if the only current policy is hope. So the same as in other sectors, for example, the tariffs, the reactions of the market give us hope. And I think we agree with that. Point 4 would be the necessary corrections in Europe. Here in Europe, the problems are a little bit different. We have to find a balance between the red tape and the effective incentives. With the proposed omnibus regulation, the Commission is adapting some EU regulations in a pro-growth way. The aim is to simplify and reduce administrative burdens. I support this because I don't think reporting requirements are the most efficient way forward. They mainly, in my experience, benefit consulting firms and data providers making business with them. However, simplification is not that simple. Initially, the focus was to be on synergies between the different pieces of legislation. Now it's mainly about postponement and higher thresholds, and this leads to new inconsistencies. So, in Austria, the threshold of 1,000 employees means that the disclosure regulation no longer applies to cement companies, but still affects social enterprises like Caritas. And I think there is room for improvement. Meanwhile, the ESG industry has been plagued by greenwashing scandals. Very well known, the DWS Group, a self-proclaimed ESG leader, has been fined to millions of euros in Germany and the US. And for all these reasons, ESG funds suffered net outflows globally in the last quarter. Nevertheless, there are 3 billion in ESG initiatives. And the total asset under management worldwide are estimated at more than 120 trillion US dollars. So ESGs still have a long way to go to become a game changer. So the solution is a deeper and liquid capital market. The equity, we have to increase the need for venture capital and equity markets. So I think the proposal by the EU Commission is not enough. The planned capital markets union should help to increase financing capacity and reduce costs and reduce the carbon footprint faster. Capital markets, and that is shown by science and research, work a lot better than banking systems when it comes to risks and pricing, and also providing the information. this brings me to point 5, the international dimension. As my former role as a World Bank director, it is very important for me as well. The global need for investment in green activities is enormous. Until 2030, it will rise to $4.5 trillion per year in order to meet the 1.5 degree target. At the moment, $2 trillion are being invested, and it's just half of what is needed. However, only 1/5 is accounted to developing and emerging countries, even though they contain 2/3 of the world's population. That means these countries are triple losers. They have historically contributed little to climate change, but they are the most vulnerable to its impacts, and they have the worst financing conditions. They do have advantages as well. So when it comes to electricity possibilities, such as access to sun, but also many important resources. So where should the money for the poorer countries come from? Probably from the rich countries and development banks. So a lot is being done. Austria is also contributing by subsidizing low-cost credits, and Austria contributes a lot and is a leader in this role. The World Bank is the biggest supplier of credits for climate-related projects. But US Treasury Secretary Bessent has called for it to invest in energy in a technology-neutral way. So the question is what that means. So should fossil fuels be financed as well? I think what is most important is a real freedom of choice, and the mandate of the World Bank Group is to finance long-term and therefore climate-friendly development projects. I do not really agree what Secretary Bessent said, but his criticism of the IMF I share. I think it should focus more on monetary cooperation and financial stability. By addressing climate change beyond financial risks, it is engaging in mission creep. So I come to the last point, the limited role of central banks. How does green finance affect us as a central bank? Primarily through our role as a supervisor, insofar as sustainability risks are reflected in financial risks. But there is more public discussion about the supposed contribution of monetary policy to the green transition. So I would like to take a brief look at both topics. Many people think green monetary policy means reducing the environmental footprint of the central bank's balance sheet. The ECB, with a lot of enthusiasm, has started to measure, disclose and reduce the climate risks of its own corporate bond holdings. Many of us said, be aware. So you don't just buy everything and everything changes, but you have to be aware. The conventional monetary policy is essentially limited to setting the key interest rates at what commercial banks can finance themselves. By easing or tightening them, we influence the financing condition. Low inflation allows for lower interest rates, which in turn favors capital-intensive sectors. So in the monetary policy, this is a no-go. You have to orientate yourself at the price stability, but not other investors. So I think that should not happen, and that is what the ECB is doing. But the insecurities related to environment is creating risks and also creating inflation, and is the central bank's task to look at them, and also also through energy investment in order to increase investments. So the central bank needs to ensure planning security and support policies indirectly. So that's one of the most important points. And now I come to the last point of my speech, the concluding remarks. I hope I have been able to make clear why I advocate for a more modest approach. Nevertheless, there's still plenty for us to do. Not everyone may agree with me, but we can discuss this during the next 2 days. I think your and my work is very important. I think green finance is a transmission channel, a driver of necessary transformation. The financial sector is only an intermediary in the economy. Central banks can help this channel to function more efficiently, but the driving force is and remains a democratically legitimized climate policy, ideally using price signals. As an economist and central bank governor, I will never give up my efforts to broad social consensus on effective and efficient climate protection. So let us join forces. Let's make the markets part of the solution. Our grandchildren are counting on us, mine are at least, and I hope we have a very productive discussion. Thank you so much.